In the early 1980s, a legendary commodities trader named Richard Dennis made a multi-million-dollar bet that would change financial history. He believed that anyone, regardless of background, could be trained to be an elite trader. To prove it, he recruited a group of ordinary people, giving them the nickname the Turtles. He handed them his private capital and taught them a strict, highly mechanical system. The core rule of their strategy was simple. If the price crossed a 20-day high, you didn't think, you didn't hesitate, you bought. For years, this experiment minted millionaires. The Turtles caught massive multi-month trends and made hundreds of millions of dollars. But then, Wall Street caught on. Institutional floor traders realized that the Turtles had become massive, predictable, and highly visible target. They knew exactly where the Turtles' buy orders were sitting. And in the 1990s, Wall Street turned the Turtles' golden rule into a deadly psychological trap. Today, you're going to learn how Wall Street broke the most famous trading system in history and how a brilliant counter-strategy called the liquidity sweep strategy replaced it. We will also show you how to use the liquidity sweep effectively. We'll also be giving you access to some pro tools you can use to spot high-quality setups, and also access to our trading channel where we share free trades. Let's dive right into it. To understand how the trap was built, we have to look at the market through the eyes of an institutional player. If you are managing a multi-billion-dollar fund like Citadel, Renaissance Technologies, and Bridgewater Associates, and you want to build a massive short position, you have a massive execution problem. You cannot just click a button and market sell your position. If you do, you will instantly burn through all available buyers, drive the price down against yourself, and get a terrible average entry price. To sell 10,000 contracts, you need someone willing to buy 10,000 contracts at that exact price level. You need a massive pool of buy orders. By the late 1980s, the Turtle strategy was so popular that every major player on the trading floor knew exactly what the Turtles were doing. They knew that whenever a market approached a clean 20-day high, a massive, predictable mountain of buy orders from breakout traders would suddenly appear just a few ticks above that line. To a retail trader, a 20-day high looks like a major bullish breakout, but to an institutional market maker, that level is a goldmine of liquidity. It is a watering hole where thousands of eager buyers are guaranteed to show up. This is exactly how retail structure is engineered today. When you see clean double tops, relative equal highs, or session highs, you are not looking at a brick wall. You're looking at a target where thousands of retail breakout orders and short seller stop losses are tightly packed together, waiting to be harvested. Wall Street traders would deliberately bid the price up, pushing it aggressively past that key 20-day high. The Turtle traders will buy, but instead of price rocketing higher, institutional traders use that exact surge of buying to match and fill their own massive short limit orders. The market would instantly stall and collapse, leaving the breakout traders holding massive losses at the absolute top of the market. What retail traders call a fake breakout or a stop hunt is actually institutional order matching. They used your liquidity to fill their position. While the Turtles were getting systematically wiped out by this trap, a legendary trader named Linda Raschke noticed the pattern. It was first introduced to the public in her classic 1996 trading book, Street Smarts. She realized that the most profitable move in the market wasn't buying the breakout, it was trading the failure of the breakout. She codified a strategy called Turtle Soup. Raschke's original 1996 rules were strictly based on daily charts and daily 20-period highs and lows. We are going to show you how to use it on the lower time frame. The first thing you need to do is identify the present trend. You can use any time frame, but the hourly and daily time frames work best. Look for relative equal highs, major session highs, or previous daily highs. Mark this level out as your retail liquidity zone. This is where the breakout orders are resting. You want to see price pierce the level aggressively, then it violently snaps back inside the range with a candle close. Wait for price to trade below the most recent support zone. Now, most retail traders will open a short position here with the stop loss at the wicks high, but price can do this, leading to a loss. Instead, wait for price to trade back inside the range, then trade back outside the range, confirming that sellers are in control. Then open your short position. This is a high probability setup that limits your loss because you're reacting to price, not predicting it. If you want more confirmation, you can use our tool. It tells you if buyers or sellers are in control at the zone, so you'll get a better entry and more certainty on the direction of the trend. You can also customize how you want to receive the signals. Visit edgecheck.online. There is a simulation that tests your trading skills, then at the end, fill out the form and a representative will reach out, or you can just send a message directly. You can also join my Telegram channel. I share free trades there if you want one-on-one mentorship or you want to copy trade our trades in real time, send us an email or direct message on Telegram. Links are in the bio. Now, the core philosophy of the turtle traders was strict adherence to a mechanical system. They were given specific rules for entries, exits, and position sizing. If the setup appears, the execution should be automatic, with no fear. Second-guessing their entry is something a lot of traders suffer from, but the turtle traders were able to overcome that. Their win rate was notoriously low, often hovering around 40% or less, by ruthlessly cutting losses when price invalidated their setup and letting their winners run for weeks or months. Their risk-to-reward ratio easily absorbed the string of small losses,